starting. It's on.
Hello, everyone. Thank you so much for joining us today in this panel session. This is probably one of the most timely we have of the ASSA sessions. I'm Lisa D. Cook. I am the chair of the session. And one thing we're going to do because of the virtual format is to make sure that you are engaged as the audience. So we're going to have presentations that are fairly brief, 10 to 15 minutes. And then we are going to engage in some questions. I'll have questions for the presenters, and then we'll open it up for questions that are interactive. But at any time, you can put questions in the Q&A. Anybody in the audience can put questions in the Q&A, and that will become a part of our exchange. So I'll incorporate your questions into the questions I already have for the panelists. So I just would like to briefly introduce all of the panelists. We have Anat Admati, who is the George G.C. Parker Professor of Finance and Economics at Stanford Graduate School of Business. We have Anton Koronek, who is the Associate Professor of Business Administration at the Darden School at the University of Virginia. And we have Atif Mian, who is the John H. Laporte Jr. Class of 1967 Professor of Economics, Public Policy, and Finance at Princeton University. Welcome to the panelists, and why don't we go ahead and jump right in. Anat is going to kick us off with a framing of the issues that we have today, and then we'll move to Atif and then to Anton. So if you'll go right ahead and jump right in. Thank you so much, Anat.
Thank you. Thank you, Lisa, for the introduction, and I'm thrilled to be here. I entitled it COVID-19 Bailout and Investor Supremacy, which is sort of the theme here. And I'm going to talk about why bad policies exacerbate inequality and injustice, and why we can change it, and we need to change it urgently. So I want to make the following big picture points, and then I'm just going to fly through, and I will post my slides later. So it will be a little fast because I do want to make it interactive. The economy, if you can think about it, as a web of legal promises, a lot of IOUs. And the question is, and here are examples in all the bullets, what happens if a shock disrupts somebody's ability to fulfill the promise? Whoever that is, who should bear the losses? Somebody promised something and is not making it, whether it's a mortgage or a student loan or a credit card or a rent or anything else, or corporate debt for that matter. Or some contracts that were sort of more implicit. Who should the government then help to fulfill the promise they made? Okay, that's a bailout, sort of preventing default. I want to briefly revisit the last time we did massive bailouts, and that was in the financial crisis 2007 to 2010, which for some of you in the audience who are young might seem ancient history. When I teach, it is ancient history to my students. But it was actually very kind of post-traumatic for me to go back and go from there. So some of the buzzwords around that period, starting in 2007, really when it started, Bear Stearns was bailed out, basically. Top Troubled Asset Relief Fund, funding for banks, for AIG, for GM, for Chrysler. So it wasn't just banks. There was guarantees to money market funds, a lot of more deposit insurance, trillions in liquidity supports that was even hard to get information about, massive purchases of government and mortgage securities by the Federal Reserve, not to mention lower interest rates forever. So the bottom line was that financial corporations and markets were propped up. There was minimal, if any, I didn't even mention it in the headline, support for homeowners, 3.8 million foreclosures. So again, you see the split support of financial markets, of certain big corporations with very minimal support. And there was a stimulus package as well, but that was sort of the bailout. This is the headlines that were there. And then here's some fallout literature, a few headlines from between. Bailout is a windfall for banks, if not for borrowers. The banks were given money to do whatever they wanted with, and they were not necessarily making loans with it, so that they would pay back the TARP loans, because the TARP loans said that they couldn't pay executives too much, or that they couldn't pay dividends, and all they wanted to do was to pay back. So the reasoning for all the bailouts were the frozen credit markets, but that's not what the banks wanted to do. And there were no conditions, very, very few conditions attached on what they'll do with the money, including return it back so we can all declare victory. The Dodd-Frank Act was signed shortly after the crisis, less than 2 years after the height of it. And to the applause of 2 minutes, President Obama said, no more bailouts, period. 2 minutes of applause came after that. So here we are today. The lobbyists said when the president signed the financial reform law, that was halftime, in the sense that there was a ton of lobbying going on that distorted that way the massive Dodd-Frank Act was written, and tons of lobbying after and since everywhere. And the law was never implemented fully, was repealed, some parts of it, and all of that. Academics tried to opine here, and I want to just talk about the imbalance. That's what the politics here. I entered this November 2010, about 10 years ago, and organized with help of other people a petition that was meant to be an op-ed, except it got to the letters section. I'll quote from it a little bit, saying that some of the reforms were really not enough. But the next day, they had Citigroup chief CEO saying all the nonsense that they say, oh, terrible things will happen and all of that. What we said is, among other things, just in 500 words, 530 words, because we had to cut them to be in the letter section instead of the letter to the G20, tax codes that provide advantages to debt finance over equity, encourage banks to borrow too much. It's paradoxical to subsidize debt that generates systemic risk and then regulate to try to limit debt. Debt and equity should be competed even terms. Many bankers oppose increased equity requirements, possibly that's so-called capital requirements, because of vested interest in the current system of subsidies and compensation. The policy goal must be a healthier banking system. And 20 people signed this, some of the biggest names in finance and some in banking, multiple by now Nobel laureates, et cetera, et cetera. And I proceeded to write a book for a year and a half that tried to explain corporate finance and banking, because the op-ed pages were not going to do it. And there were a number of endorsements. I'm particularly proud of Ken Arrow, who I admired greatly, who said that everybody cares about banking and that we are kind of exposing all the we're in opposition to the self-interested forces of obscurity. But we didn't win. We didn't win this battle. So it didn't help. So again, you know, the policy is not determined by us. 5 years after the TARP, I wrote a retrospective on TARP, saying how they made all these mistakes and they keep repeating the mistakes. TARP legacy is disturbing. Most of those who got into financial trouble, troubled assets, suffered severe consequences, many innocent people suffering the collateral damage. Those who aren't are the bankers and the policymakers. They prefer to think everything is fine when much too little has changed. So let's not say that we had such great reform. And one of the things that's really important to understand is this notion of payouts to shareholders, because you see that in dividends and you see that in share buybacks. And the way this works is it just depletes the equity that can absorb losses that can be used to invest. And so $1 paid out to shareholders is $1 that's not there to invest, $1 that's not there to back up the debt, and it places others at risk. In 2015, Ben Bernanke congratulated himself and all the policymakers, saying we had the courage to act and save this system, which is nice and good. But I ended this, one of my last op-eds on the subject, by saying Bernanke deserved a great deal of credit for helping prevent a collapse of the financial system. But in his book, he is too sanguine about the progress regulators have made. Policymakers will need courage of a different kind to stand up to the narrow interests of the financial industry and refocus the messy effort at regulatory reform. So it's unfinished business, just to put on the record. And along the way, there were warnings that something remains wrong. Okay, here's Frank Partnoy in Financial Times, just one example. Sequel to the global financial crisis is here. High credit ratings, the same things. Okay, now they call it CLOs instead of CDOs. Credit, and here's a picture from The Big Short. The credit rating agencies, the central actors, nothing really changed there. When defaults occur at the same time, the supposed AAA investments will be wiped out. He was wrong, and you'll see soon why, because of all the bailouts. To avoid a bigger crisis, regulators should heed warnings about financial dysfunction and hidden risk now before the cracks spread. So there were a lot of warning. This is no COVID. Nobody could anticipate COVID. In terms of my own learning, the corporate finance person that I wrote gave me and my co-authors, and I hope others, better understanding of the dynamics of corporate leverage in general, and especially in banking. Leverage, borrowing, indebtedness are particularly addictive, because once it's in place, you want to keep going and borrow some more no matter where you are. And so it ratchets up, but never down. And it particularly, first order effect is the corporate debt subsidies there. They're the ones that push leverage always up, up, up from wherever it is. If I give you one more chance, you'll always increase it. And the force is more intense, the more indebted you are. So in the extreme of it, you have insolvent companies, those zombies. Okay, so zombies are a word that's now being used more. And that means basically somebody who was like an underwater homeowner who, if you froze everything, would have to default, would have to go into bankruptcy. But if they don't default and they keep going, then they will just stay around. And that is very pervasive in banking, but now it's kind of more prevalent. Here is a paper from a year before the COVID, so I'm getting to COVID, which just says that zombie firms are indeed dysfunctional, have higher likelihood of being connected to a weak bank. So weak banks feed weak borrowers. Evidence on potential zombie firms crowd out credit to healthier and more productive firms. So all the bad incentives of the banks feed together with bad incentives of bad borrowers. And so we just have a really unhealthy system when you have such heavily indebted corporations. They just don't function well. So debt subsidies are distortive and counterproductive. We don't need to do that. Whatever it is that we can support, but especially in the corporate context, which can raise equity, we can support any goals. And Atif can talk more about, other goals, or at least in his research he did on student loans, on mortgage loans for households. We can get a lot of policy objective without encouraging excessive and inefficient indebtedness in the private sector by individuals and by corporations. We obviously, individuals sometimes need to take a payday loan or any loan, but if we have less inequality and less total need to borrow to feed the kids, then either would be better, or credit card excessive borrowing, etc., and avoid debt subsidies for corporations. And that's just like we're stuck with that bad policy. And it's not like other people haven't been saying it. The Economist devoted big header to it in 2015. The great distortion, saying the vast distortion in the world economy and a wholly man-made, the subsidies the government gives to debt. The Bloomberg had an editorial in 2018. Again, this is pre-COVID. Stop subsidizing debt. So we knew that. Now, entering this crisis, this is very recent from Emmanuel Sides and Gabriel Zuckman about inequalities. And what you can see here is only that inequality has increased, including in that same decade they were talking about since the last financial crisis, very much. So however you look at it, we're entering COVID with a lot of unfinished business, a lot of fragility, and a lot of inequality. So here is COVID. It just started, okay, March 3rd, the seeds of the next debt crisis. Debt levels already record high. COVID raises the risk of credit crunch in the world of low interest rates. And in this big piece in the Financial Times, Bill White, who was at Bank of International Settlement, said unconventional central bank policies may simply set the stage for the next boom and bust cycles fueled by ever declining credit standards and ever expanding debt accumulation. So again, too much borrowing. And this is the same person who warned in 2005, ahead of the crisis, on domestic and international debt, too much fragility. Now, at the start, and right a couple of days before the CARES Act was signed, over 230 academics in economics, law, and finance signed a petition that started at Stanford and was published at the Pro-Market Stigler Center blog, saying, do not bail out corporations, avoid bailing out corporations. Spending taxpayers' money on bail out large corporations is a huge mistake. The money should go to people who are most affected. The many who live hand to mouth, many will not be paid if they can't work. This is the start of the lockdown, most affected by shelter in place, and they are the ones the government should be helping. A couple of my colleagues put in op-eds saying, let the airlines go bankrupt. It's too bad. And what did the airlines do before this? They made payouts, huge payouts, okay? So the airlines paid out 45 billion, just like the banks did before the previous crisis, to shareholders, remained very fragile, and now we needed to replenish the hole with bailouts, with the CARES Act. So here's the CARES Act. It was vast. It authorized Treasury and the Small Business Administration agencies of the Treasury and the Federal Reserve, much bigger, much broader than the bailouts of 2007, 2010. And so it would be obviously impossible for me to go through all of that, but I'll do a little bit of that. So right around that, so again, a few days after that, again, two colleagues, signatories of the petition against the corporate bailout, saying that the need to help individuals and small firms gave cover for the largest corporate subsidy program in US history. So it was a subsidy to all corporations, including banks. Needs to be more transparency. And so again, we give away to vested interest. So we need more accountability, et cetera. Jesse Eisinger wrote in April, so this is just about 2 weeks after the CARES Act, how the coronavirus bailout repeats the mistakes of 2008, huge corporate payoff with little accountability. And I shudder when I read this, because this was in April. The design of the rescue package left those who watched and studied 2008 deeply frustrated. I don't have a good explanation of how we continue to fumble this. I was thinking when they started, at least we have 2008 to guide us and not make the same mistake. This will paper over banks' balance sheets problem, help tech valuations, and boost leveraged loans. No, this is 8 months ago. In 3 months, he said, the stock market will look good, but the vast majority of workers will be worse off. The law will amplify inequality and power of large corporations over labor and the workforce, and they won't be able to recover for a generation. So this is a prediction from April. We're now in January, okay? The last bailout was summarized in a book by Neil Borowski, The Inside Account of How Washington Abandoned Main Street while Rescuing Wall Street. And he was interviewed right around the CARES Act, $700 billion TARP program, which was less than a third of the CARES Act, did very little for homeowners. The CARES Act creates more programs, involves staggering amounts of money. It will be increasingly difficult to provide oversight. So the oversight since then has been a lot of different pieces. You know, here's Mnuchin pressed over the way that a lot of large corporations, the Lakers basketball team got PPP money, the Payment Protection Program. It's inappropriate. They'll have criminal liability, he said. We will monitor every loan above $2 million. But it was Treasury that created the guidelines, and the guidelines allowed for this. And in fact, they're going to have a very hard time prosecuting anybody, and they walked that promise back. So nothing is happening. A recent study of the bailouts, just through PPP, said that half of the money for small business went to large businesses. 5% of the businesses that were actually larger and got the maximum $10 million got half the money. The top 5%, the top 1% got more than a quarter. So here you have inequality in the way that this money aimed for small businesses was distributed to large businesses. And that's aside from the Fed actions, which I'll get to. Then there's fraud. Again, you know, if you do the math on it, here's one study from MIT. It seems a lot of the cash went to businesses that would have otherwise maintained relatively similar employment level. So it was very wasteful, very inefficient. And here's the Fed. The Fed went, the Federal Reserve, central banks are meant to be liquidity supporters, not risk takers, not controlling the economy, not picking winners and losers. And here's the Fed from a $1 trillion balance sheet going up to 4 and beyond. And now another $3.5 trillion and who knows how much in total assets and in various liquidity programs, program upon program upon program, that they restarted now from the same playbook as before with new additions. Main Street lending program was unsuccessful. I'm happy to talk about that, but later. And new corporate bond purchases is major and very important in feeding all kinds of things. So oversight has been lacked. And this is one story about, foreign investors benefiting from a program meant for US citizens, because you can have an offshore PIMCO hedge fund, and it would have some Delaware corporation. The Delaware corporation can borrow, can use programs by the Fed, et cetera. The Fed program in 2007 also supported the whole world, central banks and foreign banks and all of that. So now we have zombie companies in the title of headlines, multiplying and fueling new risk. This is in May, too big to fail, the entire private sector. Again, from May. CLOs, the same ones that Frank Portnoy warned about, cousin of the CDOs, package up risky loans, corporate loans, package them up just like we did for mortgages. And that was leveraged loan to already highly indebted corporations. The US market expanded from 327 to 691 billion the end of 2019. The underlying leverage loan markets doubled from 554 billion to 1.2 trillion. Rapid expansion of private equity firms and willingness of yield-hungry investors. Despite the looming risks, however, a broad package of central bank support for corporate credit has helped CLO debt prices lurch back to their lows. So everywhere you look, there is support for financial markets and support for more and more corporate debt, and also then the resulting equity markets. The boost debt binge as borrowers cut thousands of jobs. So the stock market and bond markets are doing well, the jobs are being lost. Fed is addicted to propping up the markets even without a need. Leveraging of American companies become addicted to debt. That's basically the leverage ratchet in action all over the place.
Anat?
Yes.
If you could just take one more minute, that would be great.
I'm gonna wrap it up. So
Okay.
Wall Street reaped a bonanza, the banks benefited, the largest companies are doing wonderful. As small businesses die, big companies are swallowing the world, so competition is reduced. Small businesses are being starved for credit, and the disconnect is between the stock market and employment. And so we have kicking the can, we have saving the powerful, and we have a lot of unfinished business and a broader justice agenda. I started using the word corruption. Corruption is abuse of power, of entrusted power for private gains, and it could be legal as it is in this country. Confusion and falsehood maintain it, bad diagnosis. So let's not forget to fix it, okay? We need fiscal, the central bank shouldn't be the last game in town, and my last cartoon is about how things never change. Tuesday's out, how about never? Is never good for you. So that's it. Thank you.
Thank you so much, Anat. Anat is always going to keep it lively, and we appreciate that. Atif, on to you. Thank you.
Sorry, let me share my screen with you. Can you see my PowerPoint or?
Yes. And we can see the PowerPoint, and if you, when you click, prior to your clicking on slideshow.
You need to go to slideshow mode.
Yes. Just having a little bit of trouble
Share
with
the,
that.
share the entire screen, not the PowerPoint. That'd be better.
Show them the entire screen. Okay, let me. Can you see the PowerPoint now?
Yes.
Okay.
Yes.
Very good. Thank you.
Thank
Sorry
you.
about this. So, thanks for having me in this panel. I am going to focus on sort of the macro view of this recession. And the one thing I want to highlight, which is very unique about this particular recession, is how unequal it is. It really sets this recession apart from what we have seen earlier. And one quick summary of that is this graphic. So this is showing the impact of each of the last 4 recessions on the sort of the rich versus the non-rich. And what you can see is that typically recessions are bad, but they are bad for everyone. There may be, okay, some more affected than others, but the extent of differences across income groups and how hardly they have been hit is just incredible in this particular recession. And so you can see here that the lowest earning individuals have been hit the hardest in the job market in this particular recession. The other fact which is important to keep in mind is, this is again reflecting the same basic fact, that the bottom lower earning individuals have lost the most in the job market. But the other interesting fact in this recession is that those who have been impacted the least have cut spending the most. Let me just say it again, because this is so unusual. Usually we think of recessions as, okay, you lost a job and you have to cut back spending, and as a result of that, the entire economy suffers, right? That's the typical thing we tell our students. This is completely the opposite, and you can see that in this graph. This is coming from work by Chetty et al. I've already shown you that those who earn less, the poorer, have been impacted more in terms of job losses. And yet, what is remarkable is that when you look at the spending cuts, it's the higher income individuals who have typically not lost jobs or income. They are the ones cutting back most on spending. Now, obviously, when you think about it, it's not that surprising because of the pandemic. It's the rich who are more, whose spending patterns are more biased towards, travel and restaurants and so on. They just don't have anywhere to spend that portion of their spending, and so as a result of that, overall spending has declined. But what I want to focus on is the macro impact of this behavior that we are seeing at the micro level. And there's a nice New York Times article recently that kind of summarizes that. And the quick summary of this phenomena at the micro level is that while there has been actually a lot of income plus transfers. So first, as I said, the rich in particular, they have not been impacted by this recession in terms of their jobs and income. And on top of that, the government ran this enormous over $2 trillion of stimulus program in the very beginning of this pandemic. So as a result of that, if you add those two things together, what you find is that actually, as the slide says, Americans are earning more during this pandemic in dollar terms. In fact, $1 trillion more. That's a lot of money, obviously. But because of that drop in spending, especially by the rich, we have seen an overall decline in total household outlays or spending of about $535 billion. So when you put those two together, higher income, but lower spending, the obvious net bottom line is that one thing that really sort of summarizes this pandemic at the macro level is that household or personal saving has actually gone up by $1.5 trillion during this pandemic. Now, this might, again, sound quite kind of surprising, but it's very important to keep in mind in the background that this rise in savings is very unequal because of the unequal impact. And so when you look at this $1.5 trillion, obviously this is disproportionately reflective of this enormous savings that have happened at the top of the income distribution. So that's, in a nutshell, is kind of the macro picture of what has happened in this pandemic. Now, the other point I want to make is that what I've just described to you has actually been happening in slow motion over the last 40 years. And so in that way, this particular recession has exactly hit at the fracture that had been kind of, increasing over time. And this has just kind of hit us at exactly the same spot where the economy was hurting for a long time now, which is that more and more of the savings in the US are going at the top of the income distribution. And that has created really major macro problems which are going to intensify as a result of this pandemic. So this is the other main point that I want to kind of get into in the remainder of my presentation. So let me now go back a little bit more in history and talk about how what has just happened as a result of this pandemic actually kind of doubles down on the forces that we have been seeing operating in this economy for a while now. So now let's take a broader view. As I said, what we have just seen in this pandemic has been going on for a while. We saw that the losses are kind of concentrated at the lower end in terms of job losses. Over time, we know that the gains, the economic gains, have disproportionately gone to the very top. This is the famous graph of top income inequality, the share of income going to the top 1%. But what I want to focus on is, again, the key point of this pandemic, which is it's not just about who is earning more or who has been impacted more versus less. It's also about their saving pattern, because that feeds back in a very important way at the macro level. So what I'm going to show you next is work with the recent work with Amr Sufi and Ludwig Straub, where we not only look at the income, but we look at the spending patterns of the top 1% and the rest of the population as well. And the advantage of looking at income and spending together is that you can construct this picture that I'm just showing you here, which tells us that the overall saving, this is overall dollar savings as a share of national income. So it's normalized by national income every year. The share coming from the top 1% of overall saving has been rising significantly since the 80s as well. And that has important macroeconomic implications. So let me quickly run that through. This is basically an accounting identity I'm showing you. Overall saving has to equal investment at the aggregate level. We all learned that equation at Macro 101. But that is true at the consolidated aggregate level. One basic fact from 1980 onwards is that investment has not changed much overall. In fact, investment, if anything, has gone down as a share of GDP. So let's go back to this picture. If saving is rising considerably at the top, by the top 1%, and nothing much is happening to aggregate investment, where is all this saving going? That's the question we address in this paper. And what we show is that as a share of overall GDP over this time, this saving by the top 1% is as high as the global saving glut that people talk about, which is this borrowing by the US of savings globally, primarily China. So this internal saving glut coming from the very rich is as large as the global saving glut, and its overall size accumulated over these 40 years is more than 100% of GDP. That's why this bar is over 1. So where has this gone? As I just talked about, it has not gone into investment. And when you look at the data, you do the decomposition in terms of where this saving has gone. The big answer to that is this big red line here, which is that it has the saving glut of the rich. That's the term we use for this increased saving by the very top. It has not really gone into real investment. That's very easy to see. But it has in fact gone as dissaving by the bottom 99%, or really it's dissaving by the bottom 90% of the US population. This dissaving has been done by the bottom 90% borrowing more. So you've seen that's where the rise in household debt comes. And also by the bottom 90% selling their existing financial assets to the top 1%. And that process really is the slow-moving description of what has happened at the macro level. Now, interestingly, more recently, this is where the $2.3 trillion CARES Act and other government spending run through deficits come in. More recently, the household borrowing has stopped essentially since 2008, as we all know in the US. And so that's primarily why the fiscal side has had to step in to absorb these additional savings from the top 1%. Because in the macroeconomy, it's an ecosystem. You have to balance the economy no matter what. So if the top 1% are trying to save more and more, and that saving cannot, for various reasons, go into real investment, it has to be absorbed by someone. And if it's not the rest of the household sector, it has to be absorbed by the government. Otherwise, the whole economy tanks in what is referred to as a liquidity trap. So that's a situation that we have been in for a long time. And what happens at the macro level as a result of this core imbalance, I want to just highlight that there is this core fundamental imbalance in the background, which is more and more income going to the very top who are not spending as much. And so those savings have to go somewhere. And those savings have been funneled through the financial sector into more and more credit or GDP. And that's the rise in total credit to GDP that you see on the left of this slide. But this can only happen if the interest rate on that credit continues to fall. This is something we show in the theoretical paper that is called indebted demand. But we have kind of seen the limits of that cycle because interest rate cannot go below zero much, and credit cannot go to infinity forever. And what has happened is that we were already at that tipping point at the macro level. And I just want to close at that. And on top of that, we have been hit with this pandemic, which, as I described in the very beginning, is also very unequal in nature, and exactly the same way that those who have been impacted the less are continuing to now save over $1 trillion, as I just showed you, over the last year. So they're going to load up even more on this graph that you're seeing on the slide right now. And this situation is unsustainable. This cannot go on without addressing these saving gluts, which ultimately show up as wealth, by the way. So this is very natural that you can all of this translates into rising share of wealth at the very top. And this is just incredible that the top 1% have 50% of overall wealth. But the economy, I'll just end on that, and we can have a broader discussion of what it means in terms of policy. The economy at the end of the day is an ecosystem. And when you have such an unbalanced ecosystem, it's not sustainable. And you see that in various pathologies like very low interest rates, incredible financialization of the economy, and this rise in credit and debt. We've been going through that over the last 40 years, but in a more of a slow-moving fashion that the pandemic has just put an accelerator to. And so I think there's really this serious call for action, if you will, for addressing these persistent and structural inequalities and inequities, not just for the sake of inequalities being bad, that's very much true as well, but also because the macroeconomy cannot be sustained in this manner going forward. And so that's something we need to address, and I look forward to the conversation around that. Thank you very much.
Thank you so much, Atif. Really, really appreciate that framing. Anton, let's move on to you.
Thank you very much, Lisa. And can you see my screen? Not yet. Okay, great. So I thought I want to frame my contribution a little bit more broadly and start with the public health aspects of COVID and how that directly relates to this question of bailouts and inequality that is the topic of this panel. And so I want to start out with a somewhat broader introduction than what we have heard so far. Where are we right now? Well, two very recent developments. Just last week, we passed the milestone, the pretty sad milestone that 0.1% of the US population have already died of COVID, and that's the official numbers. So the actual number is likely to be quite a bit higher. And moreover, we know that there's now a more virulent strain that raises the reproduction number of the virus from something like 2.5 to 4 and makes it 1.5 times as infectious and therefore as difficult to contain than what we have faced during 2020. Now, even though there is a light at the end of the tunnel now and we are close to having vaccines, the welfare maximizing policy from a public health perspective is still to do whatever we can to contain this virus. So I will tell you a little bit about a paper with my colleague Zach Bedun, where we analyzed this. And just to give you the basic intuition why it is optimal to do whatever we can to contain this and why there really isn't any trade-off between lives and livelihoods. We are faced with an exponential force, that's the virus, and our main policy measures to contain it all have linear costs. So whenever you face that scenario, the optimal thing to do is to contain it as quickly as possible, not only when it overwhelms our emergency rooms, our ICUs, and so on. And yeah, one of the reasons, and I guess as economists, we always have to remind ourselves of that, why there is such an important role for public policies is because infectious diseases are associated with massive externalities. So just one figure, this is based on a calibration from about 4 or 5 months ago, before we had readily available vaccines, but also before the strain became more virulent. The individual cost of a COVID-19 infection is something we estimated to be around $18,000 at the time. That incorporates, your statistical value of life and the risk that you may die, as well as the economic costs associated with COVID. The social cost of getting COVID is something like 3 times that number, around 55,000. So that means there's really a huge case for public policies to make individuals internalize that whatever they do to contain the disease, whatever they do to make themselves resistant, such as, for example, becoming vaccinated, whatever they do so they don't spread it if they're asymptomatic carriers, like wearing masks, is subject to massive externalities. And another figure that we calculated, I don't have it on the slides here, is if you are infected with COVID and you go about your life in a normal way, like not wearing masks and so on, you impose an externality of several $1,000s on society per week. So I guess we have all seen these graphs, so let me jump over that quickly. And let me now relate this a little bit more specifically to the topic of our panel. So if we want to take a step back, what are the first best policy measures in this kind of environment where we are faced with a contagious disease and where we are experiencing these massively unequal impacts that both Anat and Atif have told us about? Well, in some ways, this is really 101 undergraduate economics. There's 2 things you want to do because of these massive externalities. You want to impose public health measures. That's the first one. And secondly, because there is this hugely unequal impact, you want to provide insurance. So I use the word insurance because that's what we use in Econ 101. But in this session, one term that comes pretty close to insurance that we have used repeatedly is bailouts. And in some sense, we can think of bailouts as insurance, but of course, there's also some big problems associated with that. And the major one, and I think in some sense, we can really frame both the concerns that Anat and Atif brought up as ultimately targeting problems. We intended to sign these massive relief programs to provide help to where it is needed. And what we got instead was we got massive corporate bailouts where it's not needed. So there are 2 kind of broader points that I want to emphasize. The first one is that big crises are inherently always times of massive redistributions. And that's true both of the impact of the crisis itself. Some people die of COVID, others don't even notice they're infected. Some people lose their jobs, others, like many of us economists, can kind of save on their travel. And in some ways, our lives have actually improved. But it's also true of all the relief programs, all the publicly provided insurance programs that we have discussed over the past hour. Those also provide massive redistributions. Some corporations have gotten massively richer, others have gone bust, and the same for individuals. As Atif showed us on this very nice graph, a lot of people have actually experienced gains, and some people, of course, lost their jobs, lost their careers, and some of them also their probably human capital, which will depreciate quite significantly, and which frankly may never be needed again if our economy adjusts to this big shock. And there is a reallocation of what sectors we will need in the future. Now, the second point that I want to emphasize, and that comes from this kind of first best economic perspective, is that insurance is very much a two-way street. Insurance implies that it is optimal to take from the winners in order to provide relief to the losers. Whereas what we have discussed under this term bailouts is much more a one-way street. And a lot of the programs that have been enacted have focused only on this one route. How can the government, how can the public provide relief to some actors where it's needed and some where it's not really needed because of the targeting problems. But that's really only part of the job that a welfare maximizing policy perspective would provide us with. So Economics 101 would tell us the second basically lane of insurance is that we don't only provide to the losers, but also take from the winners. And I think over the next couple of years, as we are recovering from COVID, we'll have to really take a very serious look of that. And I think it's important to frame it in the public debate as that this is the necessary second part of what an optimal response to a big crisis with unequal impacts will entail. So that means we will have to, for example, increase taxes on the winners, to just give you one kind of policy measure that we will need to look at once this crisis is over. Now, what are the different dimensions of both insurance and also of the unequal impacts of public health? So first of all, looking at the economic dimensions, there are those who have lost their jobs, who have lost their careers. There are those who have kept their jobs, who have benefited in their careers, and who are now much better off than they were a year ago. And both of these is true for formal employees and for independent contractors. When I was preparing my slides, I was thinking of all the Uber drivers who would have driven us to the hotels where the ESSA would have usually taken place and who didn't have any business during this ESSA meeting. Now, another dimension is there are the businesses who were hurt versus the businesses who benefited who were hurt from a decline in demand and who benefited from a decline, from an increase in demand in response to COVID. There were again massive redistributions. So if we just look at the stock market, the big 5 tech companies were massive winners. A lot of older economy companies were losers. And then, of course, there's a third set of actors that we also have to keep in mind, where there were massive gains and losses. And those were localities, states, and also, and I guess that's where the scope for any policy measures is probably the lowest, also countries. We should just keep in mind that from a welfare perspective, there are massive redistributions that we have seen across countries are really a first order thing. Now, inequality is not only something that's limited in the economic sphere, but if we look at the unequal impacts of COVID, I think we should also remind ourselves that in some ways we can view our response to COVID as a gigantic redistribution from workers in the physical sphere, who are primarily low-income workers, to the elderly, who have benefited from all our public health interventions. And you know, I'm not saying there's anything wrong with that. I think that's largely speaking the way to address this pandemic, but we have to keep that in mind, that ultimately we have put millions and millions of low-income workers out of a job in order to preserve the lives of the elderly who are most at risk of dying from COVID. And in the spirit of insurance being a two-way street, we should probably also keep that in mind when we think about how do we pay for all the measures that we have enacted over the past year. Now, coming to the types of insurance that we have seen provided during this crisis, the first line of defense in any crisis are, of course, automatic stabilizers. But we know that in the US, among all high-income countries, those have been able to provide only very limited insurance. So there have been a number of ad hoc programs that Atif and Anat have already spoken about at some length. The CARES Act, the Consolidated Appropriations Act, which just passed a week and a half ago. And what I do want to point out is that in some ways, one of the big problems with these acts have been the massive targeting problems that we have faced. Even, for example, providing relief to the unemployed has been hampered by the antiquated state unemployment insurance computer systems that made it impossible to really provide the relief in the way that would be welfare optimal, to provide everybody what they lost, as opposed to some flat payment that, first of all, is not fully efficient, but secondly also made this thing politically much more contentious, because I think politically it's much easier to say, for example, we provide everybody with an 80% replacement rate than to say, well, some people will earn more when they're unemployed than when they're working, and that's an unnecessary political contention that only arises because our systems are so bad. And yeah, I guess Anat has emphasized that at length. What kind of world is that where business bailouts are provided through banks? I think there must be a world where a treasury secretary is a banker. It's certainly not an ideal system. And if we look at, for example, other countries and how they have solved this problem, we do have, at least in principle, the ability to provide much more targeted and also much lower relief that involves much lower transaction costs if we employ institutions like the Small Business Administration to engage in such bailouts. Now, one really important point, again, coming from this insurance perspective, is that the desirability of insurance is inversely proportional. Is directly proportional to our ability to target, inversely proportional to the targeting problems that we are facing. So that means, for example, with individual relief, I think there were some targeting problems that I mentioned, but we still managed to provide it to the right individuals. And that means it was very desirable, and it is very desirable going forward. Given the massive targeting problems that we faced for corporations, it is much more questionable how desirable that type of insurance and that type of relief actually is. So now turning to my last slide, what we have done in the past is we have had these automatic stabilizers that were not really sufficient in the US, and we have had ad hoc measures. And I think what we really want to think about going forward is we want to put structures in place that allows us to provide insurance, to provide relief for any kinds of disasters in the future. This would still help over the next half year when we are going to be fighting COVID, but it will also help with any types of unforeseeable future disasters. We want to have, for example, computer infrastructures in place that allow us to provide better targeted unemployment insurance. We want to have systems in place, perhaps at the Small Business Administration, that allows us to provide relief. And I think there is lots of really great examples in, for example, European countries that do have those systems and that were able to tackle the economic fallout from COVID much more efficiently and also much more cheaply than what we have seen here in the US. And what I want to point out as my final point, this is not only a question of economic efficiency, it's ultimately also a question of national security, because we don't know what kinds of disasters we will have to provide relief for in the future. And we better want to be prepared. We want to have those systems that I want to call semi-automatic stabilizers in place for any disaster that we have to face. Thank you.
Thank you so much, Anton. So what I will do is we don't have any questions in the Q&A so far, so I'll just jump in with a few questions of my own. All of you point to some sort of long-term trend, and that has to do with targeting. We are not targeting in the way we should, and we know that there's an active debate about this. There was an active debate before the most recent relief package was approved, was passed. Why don't policymakers accept the intervention that, say, CBO suggests is the one that has the most punch, say, support of state and local government? It has the highest multiplier. And we saw from the last recession, from the Great Recession, that this is where a lot of the unemployment came from. So there is something that if I just hopped in on this presentation, this panel, and I was not an economist, I would say, of course it is the case that we should target our relief. Of course it is the case that in good times, we should upgrade the SBA infrastructure, or we should upgrade the unemployment infrastructure. Why don't we do it? What is it? Is it that we're more focused on macro and this is a behavioral problem? Why don't we do it? So why don't I start with you, Anton? Let's go in reverse order.
Yeah. Obviously, there are to start with. There are a number of purely political issues, and I want to say, and this is actually not very often the case. They are not really tied to economic interests, but I almost want to say they are largely divorced from reality. So, for example, the notion that it benefits mostly blue states if we provide relief to the states, that's just plain wrong. That was maybe true in March when it was only New York that was hit. But as of the most recent situation, red states have been hit much more than blue states, and any kind of state relief package would actually have a pretty politically neutral impact, I would say. So there are just some plainly wrong political narratives that are part of the problem. I think there's also another part of the story, which I briefly hinted at, which is that there are structures in place, lobbyist systems, for example, that are ready to jump at any opportunity to achieve bailouts. And we could see that, for example, when the CARES Act came together, a number of special interests had prepared provisions that could just be taken one for one into the bill. States, unfortunately, don't really have that and didn't have that. And I think that was one of the reasons why they were excluded in the most recent round of stimulus, aside from these political factors. So I think going forward, one of the things we do want to put in place is systems that could provide targeted relief at where states needs them, that are semi-automatic, that, for example, allow us to say, well, there is a health emergency, let's roll out funds specifically for health. I mean, we really want to help the states, but we can package it that way politically, that we are providing states additional money that they can repurpose in whichever way they want afterwards, because we know that money doesn't carry labels. And I think that type of infrastructure would help us a lot going forward.
Okay. So, Atif, let me turn to you, because we have been aware of this long-term trend and inequality for a long time. We're back at the Gilded Age, right? We know that there was a massive redistribution after the Great Depression. What we see is the same kind of backlash that we saw during the Great Depression. There was a coup attempt, as you know, against President Roosevelt. His small group of bankers organizing and former military person organizing this coup against President Roosevelt, saying that this is too much socialism. So why is there this backlash again? And why haven't we done anything to close this gap before it has gotten where it is now? We've been aware of it. Policymakers have been aware of it. We've been aware of it. Academics have been aware of it. We've been in policy spaces speaking about it. So why hasn't this changed? What will change? What can change this vicious cycle?
Lisa, that's at least $1 trillion question, if not more. The two things which are very important here is, one is political economy and the other one is ideology. And I think both are very important factors here. The political economy piece it has to do with special interest, obviously. And there's a ratcheting effect there, right? The greater inequality is, the harder it is to address the problems created by it. Because the higher the level of inequality, obviously, the more entrenched those who are benefiting from the system become, and they fight back any change. And you just gave one example of that, but it's an excellent sort of a comparative history question of how big change happens, and sometimes it's not pretty for exactly this reason, that there is so much resistance to change that is really being demanded by the grassroots, that if you continue to say no, we are not going to do the right thing, ultimately it boils over in various ways. That is, as I said, not pretty. And so that political economy is front and center, really. And there's a lot of work on the political side in the US, for example, that is showing just the importance of those embedded players in preventing real reform from taking place. In 2008 crisis, Anat has been at the forefront of this, so she has been spearheading a lot of this conversation. But 2008 is a very interesting case in point. I mean, it was a housing crisis. The homeowners who were the middle class and lower middle class homeowners were affected the most, and And really, if you look at the response, it was really targeted first at those that lost maybe financial wealth early on, but they didn't really suffer in sort of in some fundamental real way. I mean, their lifestyle did not change, and yet that's where the first responders, so to speak, went post 2008. And when some of us were saying, well, wait a minute, this is really about households and those who were affected, they should be targeted, and some of the automatic stabilizers, that kind of language that Anton was talking about, some of us were talking about that. Let's do sort of risk sharing the right way. We need contracts, debt contracts should absorb the losses. That's sort of the efficient. It's just so obvious. Like you look at it, like, why are we not pushing towards? And the pushback, and there were players inside our own communities, so to speak. And again, Anat has been talking about that as well, who would push back. And there are various excuses that come about, but one of the funny excuses almost always is political expediency, that what you are talking about is just not politically feasible. But of course, political feasibility is an endogenous object, and there is a reason you find much larger support for stuff that disproportionately benefits those at the top end of the income and the wealth distribution. Because if you can come up with any excuse, okay, these are the job creators, these are and so on, there is no evidence for that. I mean, just think of the tax cut. The tax cuts create jobs at the top. There is no evidence for that. I just showed you 40 years of data that shows that at the very top, there's been more and more accumulation of wealth and saving, and yet literally zero real dollar has been added in the aggregate in terms of real investment. So what is going on? So again, I'll just end on that. I think that the political economy is really the strongest. I just see our role as academics as to try to, I think we are just a small, very small, insignificant fraction of the population, but we do have one advantage, which is that we are protected from, to some level at least, tenure and all of that. It gives us some level of protection. So I think that does impose a higher burden on us, that we need to call it speak the truth or whatever, but we need to talk about these issues, because I don't think we are going to see this coming from the pages of Bloomberg or CNN, really the core or the crux of the issue. So I think one of the answers to your question is, we just need to do our job even better or more with a louder voice.
Oh, thank you, Atif. And I think that the organization that has organized this session, the Washington Center for Equitable Growth, is one of those voices that's trying to get our work out to the greater public. So Anat, I'm going to make it even more specific. The stakes are so high. It's not just inequality. It is a financial system that could be undermined, that is a global system. So if augmenting economic growth is the goal, and therefore standards of living is the goal of every government, the stakes could be incredibly high if we ignore this in good times, if we're not breaking this vicious cycle in normal times, or breaking the vicious cycle whenever it happens. So why don't we do it? Is there any international experience that other countries have had that we might be able to follow in the United States, because the stakes are so high?
Oh, you asked so many good questions. First of all, when you asked your first question, the previous two people said the key words: politics, political economy, including within the economics profession. So I can go through that. I issued, the challenge to academics. We really have to do better. And if we had other people here who would spin other things, we would be going back and forth, saying all kinds of things, with everybody making their own assumptions and saying all kinds of things that, let's just say I'm biased, but I think wisdom is more in this panel right now than in a lot of other places that I hang out at. global, I will mention the following. So we have sort of a geopolitical problem, among other things. So one of the things that's happening in the financialized system, in the global system, is beyond supply chains and other things, the flow of money and hot money around the globe. And we don't even see it. You know, Atif mentioned, you know, saving a lot of China and all this other stuff people talk about. Well, we're not seeing exactly even how the money flows through all these jurisdictions, through all these Cayman Island, you know, incorporations, to all these systems. And what you have is a fragmented geopolitical system as well. So what ends up happening is governments and corporations kind of collude with one another, and then they are having a trouble. You have a sort of a race to the bottom on some basic rules, and you have corporations shopping rules. You have corporations shopping jurisdictions for both taxes and rules, regulations, other things, and sort of, you know, placing, you know, so it's about accounting, it's about how to tax corporations, it's about all kinds of things like that that cross borders. And you have a lot of multinationals now, and in the global power scheme, the you know, corporations are arguably stronger than and longer lasting than governments often, or they come and go in a flash, like shell corporations, which finally, at least we might know a little bit more about with this recent anti-corruption law. But really, the problems are very deep. They go both locally into the basics of even the justice system, which is sort of my interest now. I just go all the way to the very, very basic notions of rules and how you compel people to obey them across society, including corporations, corporate people. And all the way to the way, you know, Anton and Atif already hinted at, which is really key to answering your question. Why aren't we getting good policies? Because of the way the politics goes. A book about the financial crisis, the recent one, the one that got me into policy, is by Adam Tooze, which says that the political system is showing the impact of the financial crisis. That is, we had the Occupy Wall Street movement after the last financial crisis, and there were tents in front of you know, Wall Street, or in Manhattan, lower part, and there was a Tea Party. And what I want to say about the Tea Party, which has gained enormous political power in the US, is one of the motivating things, and one of the some of the money behind it was very anti-government libertarian money, Koch brothers, etc. And so what you had there is the attitude that we see. So the government was the problem, and that is a Reagan era mantra, so that the anti-government sentiment that somehow, you know, the government is a problem, and the solution is to minimize government, even though you absolutely need government, and the COVID has shown this more than ever, competent government. And so, you know, if you read, you know, Michael Lewis, The Fifth Risk and all that, you see the risk is just not having a basic functioning government that can't even transmit checks to people properly, or have channels to support employees except through banks that would just stand in the way and collect tolls, you know, for just passing on money, and et cetera, et cetera. So we just have a dismantled government, you know, more recently, more than ever. And so the challenge for the Biden team that you work with is really how to begin to rebuild a basic competent government, and how to fight against that that complete misunderstanding of the role of government, not size-wise, but competence-wise, integrity-wise. And that's really the tragedy here, is that we have so much injustice and so much corruption, and yet so many awful narratives around it.
No, thank you. That's I think the three of you have really grasped and expressed the crux of the matter. With respect to international experience, I find that we can learn from especially developing countries. And I would like to get your perspective on this. Does the economics profession have this aversion to thinking about developing countries or emerging markets that can actually do things a little bit better than we can, and we could learn from that? So let's say mobile money. As you all know, I had this mobile money proposal at the beginning of the pandemic. We could have gotten money to people a lot faster. Even if we, I wasn't conceding that direct payments were the best thing to do. This is the fastest thing to do. And then, there was all of this foot dragging about it. And then, there was just a lot of foot dragging. So that's one thing. So there's one way in which we could learn from developing countries. We could also learn the way that public health is done in some developing countries. Africa has turned out to be mysterious to some people, but some of these countries like Liberia recently had an experience with Ebola. They kind of have this infrastructure already set based on a pandemic, an epidemic that they had before. Is it that the economics profession has, where we can learn? So if we're the people who are sort of protected and can speak truth to policymakers, is it that we have this kind of aversion? And I'll give you a specific example where we have had that kind of aversion. I still have the best estimates with respect to how much the Iraq War was going to cost, based on post-conflict economies that I'd studied, Rwanda and Burundi in particular. And everybody said, oh, they're not tribal, Iraq is not tribal, we have to dismiss this comparison. And it turned out exactly the same way. But there was an aversion to colleagues thinking that this was actually comparable. And I would say colleagues, mainly political scientists, thinking that our institutions, that developed country institutions, buffered us against sectarian violence, for example. Well, we've learned how fragile these institutions are. So I wonder if that is part of our impediment, that we're not taking the comparisons where they actually should be. What do you think? What do you think, Atif?
Thanks, Lisa. First of all, it's interesting you asked that question. I was trained as a development economist, actually. I sometimes joke that I used to, my early work is on emerging markets. I used to work on emerging markets, and then the US became an emerging country. But obviously I sympathize a lot with this, that we need to learn from other countries, and there's a lot one can do that. I think there's a connection to your question and what Anton was talking about, and I would just like to emphasize that aspect, which is there seems to be a deeper problem in the US, which is that the country is finding it very hard to do public stuff. I mean, there's just so many examples of that. My favorite one is healthcare, right? It's something that the US devotes the largest amount of its budget and resources to. And look at how inept and inefficient the US is in the outcomes it generates from that spending. Well known, right? That compared to other OECD countries, it's like absolute kind of the bottom of that list in terms of what we get for that money. And it's basically a reflection on the efficiency of the health system. And in many ways, that was just revealed when the COVID shock hit. And the obvious comparison is to compare the US with sort of the fastest rising emerging market, now close to developed, is China, or recently developed like Korea or Taiwan, or another developing country, Vietnam. When you compare, the US response, which was a public health crisis, so the Teslas and the Amazons of the world could not respond to a public health crisis. It was really a test of your bureaucracy. It was a test of your state apparatus. It was a test of, and it's it's fair to say that we failed miserably. And it's really not about many of us can be partisan at time, but it's not a red versus blue state question. I mean, the blue states are equally miserable as red states in terms of responding. So I think there's a very deeper malaise here that is set in, that the US has really become very efficient in doing certain things, and they are very apparent in what we are very efficient at. But at the same time, it has become more and more, and there's really not much work done on that. I mean, I think it's a fascinating area to really look into. Like, try building a road in Pakistan. Not Pakistan, sorry, I am from Pakistan. That's where I slipped. Try building a road. It's also true for Pakistan, by the way, but that's a whole different conversation. Try building a road in the US, update the subway and so on, and look at the cost of what it takes to do that in the US versus when China does the same thing. And so there's really a bigger question here to think about. Over to Anton. I think he wants to say something.
Right, but if I can ask in one finger, we then asking what is a public good? Have we as a political body, as a society, become averse to providing public goods, a narrow range of public goods, only if they have to do with, say, national security, like our canonical examples that we start Act 10 or Econ 1 with, national security, and clearly, to some limited extent, public health. I mean, we start with those examples, but we don't get very far after that. And I think there's been an assault, and this has been possibly perpetuated by the economics profession. If we have been questioning whether these should be provided, if market failure is the only reason for providing public goods, and we know that's not true, right? I mean, there's a moral argument for providing some public goods. We as a society believe they should be provided publicly and not just as a result of market failure, but that's often the way we teach it. Anton.
Yeah, I think, Lisa, you hit the nail on its head. I think you're right that market failure, externalities, public goods are not the only reasons why we want public intervention, and that there's also a very strong, I would say, moral case for policies that enhance inequality. But at the same time, I think even the justifications that you mentioned, like public goods, externalities, are basically terms that have gotten lost in our public discourse. I mean, we are facing a situation where even the most obvious externalities, like, let's say, global warming, that are uncontested around the entire globe, are contested in the US. And the same is true for the public health externalities that arise now in the context of COVID. Let's say, for example, externalities from vaccinating, which are going to be one of the big questions of public debate in the coming months. All these things have basically disappeared from our public discourse, and are things that have become contentious, even though they are basic welfare economics 101. Now, one thing where I think our profession can do perhaps a little bit more. I was recently trying to basically teach an undergraduate student who does an independent study with me about externalities and public goods. And I was kind of a bit dismayed to go through one introductory microeconomics textbook after the other and see that in each one of them, the question of externalities was basically in the last few chapters. So I think it is true, it is something where we can basically raise the salience of these issues a little bit more, including in our undergraduate education.
Oh, good. So I agree, and I think that there may have also been a long-term assault on the minimum wage and on unions in our teaching of economics. And I'm not sure that the benefits, there's only so much you can cut until you actually of a human body, until you reach the bone. And I think this is not only part of society, but part of our economy. Let me pivot to something else. With respect to,
Lisa, I have a comment. I have a comment.
okay, I'm sorry. Yes, please go ahead.
I want to say something about this because our language as economists is such that we can only frame things as, the government is over here, the government intervenes if the market fails. But what we don't say is that there is no market without government, in the sense that our markets are not like the spot markets, where we need contracts, we need property rights, we need all these things. The notion that the government just intervenes, then the idea that, because that the narrative is that somehow, it's from market failures, but there is no market. There is no competition without the government ensuring it. So I think it's very, very basic. And so it's in our language as economists that we don't understand things about power. We don't even have a good model for power. We use it in bargaining power, market power. We sometimes use the word power, but who sets the rules? So it's endogenous. What Atif was saying too, political economy is endogenous, but we ignore it. We come at it, as Abba Lerner said, to solve the political problems. That's our domain. So we make assumptions, but our assumptions are often wrong. So I think it's sort of at the very basic level, we economists are just refusing to actually see the bigger picture of what creates the outcomes. And we just have a few modules by which we can frame it at all. So I think it's more fundamental. I also have an undergrad course I teach, which is called Finance Corporations in Society. And so I have more to say on that, but I want you to get to your question. I just wanted to quickly add that.
No, thank you for doing that. With respect to what economists can do, after the last crisis, I created a course called Finance and Public Policy to try to train people who were interested in public policy to stay one step ahead of financial innovation. I was somewhat dismayed because the leading question that I got after the course was over and I was talking to the students was, okay, so how can I now get a job I told them I'd been at Salomon Brothers. How can I get a job at Salomon Brothers? So, this almost feels like a fool's errand that we don't pay, governments don't typically pay the salaries to be able to ward off financial innovation that has negative consequences. And I think that there's a larger debate about cryptocurrencies, about digital currencies. And it's not just with the financial system, it's also with cybersecurity. I mean, we started the Trump administration with a hack by Russia, and here we are again. How do we provide the incentives to care about public goods, whether we're economists or the general public, the policymakers? Do we have now, and I'm asking this question because we all know we were alive when this was happening. Okay, Anton may have been a little bit younger, but but we were alive when the Eurozone was being discussed. And there's a whole literature on political economy and the kinds of questions that we're posing now about the provision of public goods with this new superstructure. So I'm just asking, why haven't we put this back at the top of the agenda in journals, in our publications, in our research? Anton, did you have your hand up? Did you want to start? Do you want to start with that? Oh, yeah. he told me his age. Okay, all right, fair enough. Did you want to start, or Anat, did you want to start?
Well, I mean, I think again, it's deeper. There's something going on about societal, about culture, about what people want to do. You know, I teach finance and society, and then I kind of have a hidden agenda, both to make my students more civically active and appreciate more, you know, role models who are people who, you know, who are committed and who are passionate about public policy, about being in policy and all of that. You know, I myself, you know, the politics is complicated, but in any case, so I think, and apropos your issue about technology and cybersecurity and all of that, the one comment I make on that is that, you know, competence these days, you know, does involve just having the right information and being able to reach people and all of that, even in targeting supports and things like that. And you were mentioning, you know, so M-Pesa or whatever other innovations there are. One of the problems, the things you're trying to get at is sort of narrow-mindedness in general, and a notion of somehow superiority. We think, you know, we're democracy, end of history, you know, we're better. So we let private companies surveil, but the government can't surveil, you know. So we can't allow the government to know too much, but Google knows because we agree for it to know. So we kind of allow tech companies to privatize, you know, all kinds of information about our every move, but then we resist the government knowing too much because it would abuse it. So we don't trust government, and government has not done much to make us trust it either. So we kind of need more, you know, a more trustworthy system where, you know, where people care. Why people don't care about society is kind of a really deep question, because it has to do with, you know, with whether, you know, we're so individualistic that, you know, winning and making money is kind of what society treasures, and doing good is not valued.
Lisa, I just want to respond using a very famous paper by Holmstrom and Milgram, which I really love. It's on multitasking. And the key insight that I learned from that paper is that in a world where almost every job is like, it has some multitasking element to it, which is to say that if you think of teaching, there's a way you can teach which is good type of teaching, and there's a way you can teach which is bad type of teaching, right? You can teach the test, or you can really sort of teach the student wisdom. That's true for most things, and it's certainly true for most of the important stuff in life. When you live in a world where agents who are being told to do something, who are being incentivized to do something, can choose good effort or bad effort, that's what I mean by multitasking. And that's the world we fundamentally live in. The question of incentives and market structure is a two-edged sword, really. We want to use markets and we want to use incentive structure. So we obviously don't want to go to communism or whatever the other extreme might be. But I think what the fundamental insight that comes out of that is that you must understand this two-edged sword, and you must, as a result, maintain a balance between the market financial incentives versus not overdoing that so that you load up so much on the bad type of effort. And finance is the prime example of that, that it has just, you know, sort of gone to the nth degree on financial engineering and so on, that serves absolutely no social purpose. And what that means is that the question of institutionalizing incentives is paramount to how efficiently a society runs at the end of the day. But that's a decision. Unfortunately, that's not a decision that your students, or when we teach us, make that decision. We take that as given. And what has happened over time is that in the US, the structure of incentives has gone so much in the direction of just loading up on this is where you can make $10 million in 5 years, versus you can do a public policy track. Okay, I'm willing to take some cut, but come on, I'm looking at 10 million on one side and I'm looking at, I don't know, 60,000 on the other. You know, for a smart kid, it's like, what do you do? That's too much pressure. I mean, come on. So that's, so I think we have to think of incentives the right way, which is to say, yes, people should have incentives, but there is a way when too much incentives is not good or not useful. And that goes back to all this discussion about inequality and top marginal tax rates and wealth taxes, by the way. What is the right tax structure fits very much in this conversation. If you look at the tax structure, talking about incentives, that's partly where incentives derive from. It's incredible how really regressive the US tax code actually is. I mean, when you sum up the payroll taxes, the sales taxes, and so on, that's the right way of looking at the property taxes. That's the right way of looking at it. What you end up with is a tax system that's incredibly looks like a flat tax, actually, that you roughly pay a very similar fraction of your overall income in taxes of all kinds, whether you are earning $50,000 a year or whether you're earning $50 million a year. So that's something, and so we really need to change that overall system of incentives, and that's really structural reform. I think a lot of this conversation is really pointing towards kind of the obvious, which is, and this is my beef with whatever, blue or red, whichever party one belongs to, is that we really need structural reform. When we talk about structural reform, that's what we are talking about. We are talking about reforming the fundamental structures that provide incentives to our students, the exact example that you gave. And we really need to change that. And that does require, changing the tax structure and changing things at the root of it all. And we need those kinds of changes that the politics is at one level least willing to do right now, but at the same time, you can see this pressure, from the right and the left. You can see this pressure building up. So I think that change needs to happen. I see our job as hopefully trying to, drive it in a good direction rather than this spilling over in some bad way.
Right. No, I agree. Go ahead, Anton, and I'll go to a question in the Q&A. Mm-hmm.
Let me perhaps pick up on Atif's cue to start a little bit with talking about cognitive science and our way. He spoke about multitasking. I wanted to point out that with a number of the issues that you brought up, pandemic preparedness, cybersecurity, one of the issues is that they are relatively small risks. Like, let's say a year ago, you would have laughed me off the stage when I would have said, well, we really need to be prepared for this pandemic that may hit us, given that on whenever it was December 31st or January 1st last year, the first reports of COVID in China surfaced. And our minds are just not very good at dealing with these small risks. We have a cognitive bias against them. And I think one of the probably most effective ways of making us act in a smarter, more rational way in the face of those risks is to personalize them. It's much harder to convince people that we need to spend on cybersecurity if we just put it as an abstract statement than if I talk about grandma logging into her retirement account and it is cleared out, or if I talk about our children being poisoned by radioactive radiation that was released after somebody hacked our power grid. Then I think there is another cognitive bias that relates to what Atif continues with, that it is much harder for us to pursue less measurable kind of soft goals than to pursue hard goals. So in Atif's example, that you can tell a college graduate, well, you can pursue this career in banking, your starting salary is going to be significantly higher, your bonuses are going to be really large, versus a much softer payoff if you pursue a career in teaching. Again, we have a cognitive bias to go after the measurable. And I think if we work on kind of reminding us of these biases and counteracting them, that would go part of the way of realigning incentives in a way that would make our society a better place.
I completely think that you're right. But we had Ebola victims in this country. Ebola was on our shores. A pandemic was here. We were sending the CDC down to Liberia and to these places in Africa. That's as close as we can get to a pandemic. And we had, SARS was here. It was actually here. We had a pandemic playbook. I think it was like 67 pages and a plan, a play-by-play plan, and an office that was devoted to it. So I wonder if short-sightedness has become part of our maximization problem, no longer a constraint, but the maximization problem, the objective function itself. We can personalize it, but we know people. I mean, a lot of us may not know people because not very many people died in the US as a result of Ebola. But we don't have to see these small probability events as zero probability events. I mean, whether we're thinking about the financial system or we're thinking about a pandemic. But let me get to the question that's in the chat because it hits at some of the points we brought up. As professors and experts in your field, how would you recommend students get involved or learn about finance and public policy? I think all of us teach undergraduate classes, so it seems like that's geared more towards undergraduates. Anat, you want to?
Yeah, well, I'm in a business school that itself is independent of the college. So we don't usually teach undergraduates, but actually thanks to some discussions with Princeton way back, I got to teach undergrads, and that is a lot of where my passion is. However, I will say as well that one of the problems when people say experts in your profession, our professions have become very narrow. So we are very siloed in our profession. So economists don't talk to law people enough, or to political scientists enough, or even to behavioral scientists enough, sociologists, etc. So we are just, we're siloed. So part of the problem is that you really, in order to really understand what's going on, your discipline will often not be enough to tell you what's going on these issues. There's just too many components from too many places coming. And our own disciplines do not give us incentives to go broader. So my efforts to break academic silos among my colleagues who are failing, but the students are more amenable to all of that. And it's true that the students would come and say embarrassingly, sheepishly, oh, I want to work, and some of my best students have gone to work for investment banks, etc. And I tell them, it's okay. It just, you need to maintain your big picture. Some of them, do get a grain of bigger picture in their head, and they, I get email now from somebody who worked in a hedge fund wanting me to connect them to, the transition team or whatever, because that's what they want to do. So you have people who want to do that. How to learn that, that's the difficulties that our courses are very, very narrow in general in academia. So connecting the dots is rarely going on, especially when it comes to some of what we do in professional schools. What is accounting, what is marketing, what is all these fields that we teach in a business school, just what are they, what do they do, and how much they affect the world, versus what law people do and what lawyers do affect the world for an undergrad to understand. So that's some of what I'm trying to do, but I don't know that there's enough of that going on in colleges, or potentially even down at the high school level, to some extent. In other words, the way we teach the world to people, to young people, is fragmented, I worry. But I think that it's possible to put the dots in. It's just that we don't make it easier.
Right. Atif, you teach an undergraduate class, did you say?
Lisa, I'm happy to take this. I'm actually, these days I'm teaching high school because my daughter is taking economics in high school. And so I'm
right. Okay. All right.
teaching high school students these days. And it's actually, let me be honest, it's incredibly frustrating the way we are teaching economics, and this is macro in particular, and I've seldom felt more frustrated than teaching my own daughters a field that I study myself, because it's just terrible the way we are teaching them at the high school level. I can't really say that to her because I want to teach her something. But let me just say one thing. I think in terms of my broader take, look, I think if you approach this question from finance and public policy, you may have lost half the battle already. That's my perspective. I think you have to think, especially when you talk about policy, you have to think at the system level. And from that perspective, you cannot really ignore economics more broadly defined before we dive into finance. Because you basically use the big picture. Just start with finance, define the traditional way. So my first advice would be that, look, at the end of the day, what we say about public policy or economics, it's really about understanding I use this term often now, the ecosystem, which is everybody connected to everyone else through economic transactions, through the sort of the assets and liability positions we hold off of each other and so on. But what all of that really means is that we are trying to do, my late colleague who's now passed away, Uwe Reinhardt, he used to use this wonderful term that, we are just trading favors with each other. And that's really what the economy is. And we put value investments on those favors that we are trading. And that's really the way to think of I think that's the way we want to think of the economy, the society. And that's really what it is at the end of the day. I think it's a lot of the other questions, Lisa, that you raised about the politics and about the society at large. We make the economy sometimes as this mechanical construct that has rules. No, it has no rules in a way. There is an objective function at the end of the day, that is, we want to live a decent life. And I hope you all know what that means. In some fundamental sense, there are no rules that taxation can never be more than 35%, or wealth tax has to be 0 or something like that. All of that is bogus. There's only one objective function at the end of the day, which is how can we live together in a mutually beneficial way? And this goes to externalities and all of that. I think that's where the economics really comes to life. When we talk about that symbiotic relationship that we have with each other, when we talk about the stuff that is of mutually beneficial to us, but for various reasons, we will fail to internalize what is in the best interest collectively when we think too selfishly. I think nothing has been worse to economics than this notion that economists are about capitalism, which is about individual behavior. It's like, nothing of interest in economics I've learned by just looking at individual behavior. Everything of interest that at least I know, that I find exciting about economics, is about macro behavior where the sum is bigger than the parts. That's what is exciting. And I think that should be the starting point.
No, that's right, which is why I have to keep reminding people that I'm a macroeconomist. So every question that I'm asking feeds into a macro question. But it's interesting you should say this, Atif, because one of the books on the syllabus is Fishing for Fools, George Akerlof's book. You can't, it's not just one type of financial innovation that can undo the system. There are all kinds of schemes, but they are based on systems. You really have to think about a systematic level. So I'm glad you brought that up. One question I'd like to ask you all, though, before we leave, before we run out of time, has to do with the post-pandemic economy. I think one thing that has been revealed is inequality along many different dimensions in this country and abroad. One is the racial dimension that has to do, say, with occupational segregation. This is an age-old problem. My column in the New York Times addressed the economics of racism and what it costs us. And when you see these numbers, whether they're the estimates from Mann and her co-author, Mann and Peterson, of $16 trillion, or Shea, Clennell, Hurst, and Jones of 20 to 40% of productivity or of output, those numbers are huge. What are we going to do to understand how to change this, and what are we going to do to change this? This is inequality, not with respect to income and wealth, although they're very intertwined with race. What are we going to do about this post-pandemic economy when maybe there's not as much attention to essential workers? Maybe there's not the same kind of attention to healthcare disparities, and George Floyd is a distant memory. What are we going to do to make this right in that sense? We haven't talked about the racial dimension of it. Anton, do you want to kick us off there?
Yeah, for me, it starts with viewing our whole response to the crisis now as the two-way street that I mentioned it needs to be. And we have seen lots and lots of measures going in one direction, however badly targeted. But now, in a couple of months, when we will hopefully see the light at the end of the tunnel, we really, really need to make sure that the winners of this pandemic are contributing their fair share to compensate all of those groups who have been among the main losers, whether that be racial minorities who have been disadvantaged by the pandemic more than anyone else, whether that be mothers who really experienced a dent to their career because they stayed home with their children, and so on. And I think we really need to focus on making this two-way street work, on making sure that the winners do actively pay their fair share to compensate the losers.
Okay, thanks. Atif?
Thanks, Lisa. You raise an absolutely important question. Let me just say one thing, which we must come up with a way we want to measure this thing properly at some level, because we now live in sort of, I feel sometimes, this multimedia, whatever show business world where there are fads when we love talking about stuff, but nothing really happens. And I feel that way about racial injustice and inequalities and all. It's now you have to talk about it if you want to sound serious, right? But I want to kind of put our feet to the fire, so to speak. And so I think when we talk about on this question from a policy perspective, I would like to put in place a structure of measurement, really, where we say, okay, where are we as a society on metrics that we really care about? I mean, there's been sort of this discussion of GDP is not just a good measure, we need other measures and so on. But I think on this question of, and sort of, for example, I'll give you one. I think Raj Chetty has just phenomenal work in related to this area and so on. And I think some of those tools can be brought to bear to bring administrative data directly to tie into these questions. So when politicians talk about racial equity, we say, well, hold on a minute. We heard the speech 4 years ago, but what does the mobility rate now look like for Black youth going into employment versus 4 years ago or 10 years ago? So on and so forth, and just for any group that you care about. So I think because nothing is happening on the ground really. There is more chat for sure. This goes back to all of the conversations we were having, that we did the structure needs to change and so on. And so I think partly when you put, I strongly believe that my colleague Angus Deaton once said something to the same effect, that when you start measuring something properly, that by itself is like a big change that you can eventually make, because now you force people to say, look at this. And that's why GDP growth really, always it hits you, okay, now we are in a recession because everything is defined by those measures. So I think we really need to now look into this question of, is everyone born having the same set of opportunities in front of him or her when they start their life? And that should be the metric by which we judge ourselves as a country. That if that answer is very different for which zip code you're born into, something is wrong. And so I think we need to just define that and then measure ourselves by that yardstick going forward.
It's interesting. I'll come to you in a second, Anat. It's interesting because in the last recession, the literature that was spawned was the happiness indices, right? So this was Amartya Sen, it was Joe Stiglitz, there's a whole commission that was set up to study the measures of happiness using the American Time Use Survey and similar surveys internationally. So I think that the Great Depression did something like this to our national psyche too, and to academia, where we started investigating questions that didn't have to do with material well-being, but with well-being more generally. So I think that it is right that this is a time for us to do it, but I don't see it. I don't see that yet. I don't see that literature yet. Anat?
Well, I just want to say the following. You know, we got obsessed with GDP, which is a terrible, terrible way to live, you know, to measure life and to have the answer always being growth, 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 you know, of that number, of that GDP number. Now, you know, there are incremental things to do. So to your point of why nothing ever changes, which is why my cartoon at the end was expressing that very frustration, you know, how about never, would never work for you, you know, so how will it change? How would things change? So I very much am sympathetic that there's incremental stuff and there's actually daring to talk about the big stuff. Okay, so incremental stuff is, you know, specific things. Early childhood education. In other words, when we're told that racism is over, you know, and the voting rights, we don't need it anymore, et cetera, that's just false. We just have to kind of fight the point by point to say that's false. People do not have the same opportunity. Go back to, you know, busing people or whatever, if there's neighborhoods are segregated, you know, go for the specific things. And big picture, yes, you know, Germany paid reparation for the Holocaust. You know, I don't know that this is not, you know, to dare, once you say it, maybe it's legit to start talking about the small things because, you know, reparations is so difficult to do after so many years of injustice. So, you know, I think we should dare to say, to acknowledge that we had a problem in this country, that we still have implicit biases and implicit, you know, racism and sexism and whatever else in this country, and we need to, you know, have metrics, as Atif said, to measure that. But it's not enough. We need to propose specific solutions to specific problems, locally, doable now, and aim for bigger justice.
You know, I think you're right. I think that one of the things that has to be acknowledged, and I think your cartoon does this, we have this this intertemporal problem, this intertemporal inconsistency problem, and we have sort of big ideas, I think, that get carved up into smaller proposals. And the smaller proposals are what we do, but we never get to the larger thing. And then it's on to the next crisis, right? So I just wonder.
Short-termism is a sort of, it's a blindness to future. It's an inability to comprehend whatever is the psychological impediment.
No, I think you're right. And I think that the whole question about shareholders and shareholders versus stakeholders, and are trying to possibly inject more long-term thinking into shareholder behavior, and therefore into manager and CEO behavior, I think is still a very lively one. But as you all are pointing out, I think my Nigerian friends who say this are right. There's always a lot of motion when something like this happens, but not a lot of movement, right? You know, you see there's a lot of activity with respect to talking about systemic racism or these racial disparities that seem to be everywhere, right? In every facet of society, which suggests that they're systemic. But we're not necessarily addressing it, breaking it down into small parts so that they can be addressed. And on a local level, I mean, I think this is the task of the profession to, in our departments, in our government agencies, wherever we are, that this happens, because it's not gonna happen just by the AEA articulating what might happen.
On the optimistic note, you know, for some, you know, for some of the gender issues or the you know, equality of sexual preferences, some things did change over the years. So you kind of, you know, awareness and persistence sometimes do bring about change. You know, there have been accomplishments, you know, women are voting, you know.
Right. And African Americans are voting, and I hope they'll continue to do so. And everybody, right? So yes, I mean, I think that there are definitely some advances that have been made, and I hope the economics profession will keep feeding into this process that you all have been contributing to. And I hope that our students will feed into as well, and not just ask us about jobs on Wall Street. Anyway, thank you all for joining us. Thank you, panelists, for this lively discussion and informed discussion. And enjoy the rest of the ASSA meetings. Bye-bye.
Thank
Thank
you.
you, Lisa.
Thank you.